Welcome to the Riskwiser Zone, the podcast where we dive into the world of finance and explore the latest trends, risks, and opportunities. I'm your host, Lewis, and I'm excited to have you join us today. As we start this episode, let's take a look at the current state of the housing market. With property prices continuing to rise, many potential homebuyers are wondering if they'll be able to afford a home in the future. Recently, an article caught my attention where the author asked ChatGPT, a popular AI tool, whether buying a house will become more affordable in 5 years. The results were interesting, to say the least. According to ChatGPT's analysis, the median home price is expected to rise from around $420,000 today to between $510,000 and $580,000 by 2030. This prediction is based on an assumed annual growth rate of 4% to 6% in home prices, inflation averaging 2.5% to 3%, and mortgage rates remaining within the range of 5.5% to 7.5%. While this may seem like bad news for potential homebuyers, ChatGPT also offered some valuable advice on how to make a home more affordable. Firstly, it's essential to start saving aggressively now. This includes setting aside funds for down payments and closing costs, which can add up to around 25% of the total purchase price. High-yield savings accounts or CDs can be a great way to grow your savings, although investing in stocks or index funds may offer even higher returns, albeit with some level of risk. Another crucial factor is building and maintaining a good credit score. Aiming for a score of 740 or above can help you qualify for better mortgage rates, which can significantly reduce your monthly payments. It's also important to avoid taking on new debt and paying off credit cards in full each month. Additionally, first-time buyer programs may still be available in 2030, offering low down payment options and closing cost assistance. These programs can be a great way to get into the market, especially for those who are purchasing their first home or haven't owned a property in the past 3 years. However, it's also important to consider the rising costs of ownership, including property taxes, insurance, and maintenance. These expenses can add up quickly, so it's essential to factor them into your budget when calculating how much you can afford to spend on a home. Finally, pre-qualifying for a mortgage and locking in rates when possible can help you understand your budget and potentially secure a better interest rate. As we explore the world of finance and housing, it's clear that there are many factors at play. While some may argue that the housing market is becoming increasingly unaffordable, others see opportunities for growth and investment. As always, it's essential to approach these topics with a balanced perspective, considering both the risks and potential rewards. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and technology. In this segment, we're going to take a closer look at the tech giant Broadcom and explore whether its stock is a buy or not. So, let's get started. Broadcom has been making waves in the industry with its strong demand for AI-related products and services. The company recently reported revenue of $15 billion in the second quarter, up 20% year-over-year, with adjusted earnings per share of $1.58 jumping 44%. These impressive numbers are largely driven by the surging growth of AI, which saw revenue related to the technology grow 46% to $4.4 billion. Now, management expects this growth streak to continue, guiding for revenue of $15.8 billion in the third quarter, representing a 21% increase. The company also pays a modest dividend of 0.59 per quarter, with a current yield of about 0.8%. While this might seem like a small return, it's worth noting that Broadcom has a payout ratio of 63% and increasing profitability, which could lead to future dividend increases. But the question on everyone's mind is, should you buy Broadcom stock now or wait until after earnings? Well, as we always say here on the Riskwiser Zone, it's essential to look at the bigger picture. While it's tempting to try to time the market and invest just before a catalyst like an earnings report, long-term investors might be better off buying the stock and disregarding the daily fluctuations of the market. With 43 out of 47 analysts rating the stock a buy or strong buy, and none recommending selling, Wall Street seems to be extremely bullish on Broadcom. Management is also optimistic, estimating the company's addressable market for AI revenue to be between $60 billion and $90 billion in fiscal 2027. And with the announcement of 2 new customers onboarding, although details are scarce, it's likely that future results will get a boost. Now, we know what you're thinking. Isn't the stock's valuation a bit steep? With a price-to-earnings ratio of 37 times next year's expected earnings, some might argue that it's a bit on the high side. However, considering the vast opportunity in AI, with estimates suggesting it could contribute $15.7 trillion to the global economy between now and 2030, perhaps the valuation is justified. So, what's the verdict? Should you buy Broadcom stock right now? As always, we recommend doing your own research and considering your individual financial goals and risk tolerance. While the evidence suggests that Broadcom is a strong player in the AI space with significant growth potential, it's essential to approach any investment decision with caution and careful consideration. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic discussion so far, exploring various aspects of personal finance and risk management. As we wrap up today's episode, let's take a closer look at the current state of savings rates and certificate of deposits, CDs. As you may have heard, the Federal Reserve has reduced its target interest rate 3 times in 2024, which has had a ripple effect on deposit account rates. This means that now could be your last chance to lock in today's high rates with a CD. We've got some interesting data to share with you, and we'll break it down in a fair and balanced way, as always. According to recent reports, the highest CD rate is currently 5.5% APY, offered by Gainbridge on its 5-year CD, with a $1,000 minimum opening deposit required. Now, let's put this into perspective. National average CD rates are significantly lower, with the highest national average interest rate for CDs standing at 1.77% for a 1-year term. It's essential to shop around and compare CD rates from various financial institutions to find the best fit for your needs. Online banks tend to offer more competitive rates due to lower overhead costs. Additionally, consider the minimum deposit requirements, account terms, and conditions, such as early withdrawal penalties and auto-renewal policies. We've also identified some promotional CD rates available in August, with rates up to 4.4% APY. However, it's crucial to weigh the pros and cons of each option and determine whether a CD aligns with your investment goals and timeline. As we conclude today's episode, remember that investing always involves some level of risk. It's essential to stay informed, assess your options carefully, and make decisions that align with your financial objectives. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.